got Pranav Gundlapalle from Bernstein joining in on the show right now to talk about exactly that. Pranav, hi, good to have you on the show. Lots to talk about when it comes to banks and financials. But let's first start off with what's happening within private banks and what do you think the pecking order is looking like right now? Because there's been quite a bit of rotation that one has seen off late.
Morning. So I think the way we're seeing it is a reversal of the tightening moves that RBI used over, say, let's say last 12 to 18 months. I think things are getting better, and therefore we are probably off the worst point in terms of growth. We should start seeing an improvement in growth. And in terms of a pecking order, we still prefer the large private sector banks, with HDFC, ICICI, and Axis being the top picks for us. The reason being that while the overall liquidity environment improves, we don't see a rapid growth in the consumer credit space. So we prefer lenders who have a more diversified portfolios, and hence the preference for the large private sector banks.
But if RBI is pivoting, isn't it a good time to perhaps look at companies or banks or franchises which would benefit if the liquidity environment improves, if lending picks up? Because after this recent leg of decline, that's where the stress is in terms of prices and opportunity.
Right. See, I think liquidity improvement would definitely benefit the overall space. But we don't see a big rebound in the consumer lending space, right? So if you look at even RBI's recent actions, the risk weight reduction has happened more on the MFI space, the lending to NBFC, rather than a direct cut in, say, risk weight of consumer loans, which was increased a little more than a year back. So we think that space might not see a big deterioration in terms of asset quality, but would growth come back to what we saw in, say, 23 and parts of 24? Answer is no. And hence we prefer the more diversified lenders who also benefit from liquidity. So if you look at the large banks itself, the likes of Axis and HDFC are levered quite significantly to liquidity, and an improvement there should help their margins quite significantly.
Because they are institutional favorite and your institutional brokerage, is that the spirit? I mean, just trying to understand the thought here.
See, if you, again, look at the NBFC space, so there are two options, right? So you look at the banks or the NBFCs. Now, we prefer banks over NBFCs for the consumer lending reason that I mentioned. And within NBFCs, again, if you say consumer or the overall risk weight increase helps NBFCs, the valuations already account for a lot of that. So you put a valuation layer over it, then we prefer the banks over NBFCs. And within banks, private sector over public sector, because the public sector banks will go through this phase where their loan growth will converge with their deposit growth. We're slowly seeing that play out. And we don't think that's fully priced in yet. So that's the reason for picking the large private versus those public sector banks.
All right, but Pranav, also talk to us about the loan and the deposit growth outlook, because we have seen those rates moderating from the mid-2024. Now we are seeing that the December month of 2024, these numbers moderated to almost single digit now. But now that the liquidity pushes through, how do you see these numbers going ahead?
Well, we don't. Okay, so we saw a bottom in our view in December, where the loan growth and deposit growth was at around 11.5%. And primary reason was the tight liquidity, where RBI, and again, because RBI was forced to step in to protect rupee and intervene the FX market. We think it gets better from here, but not by a very big amount. So we think loan growth and deposit growth should head back to 12 to 13%. That's the range we see. And that would be led by a broad-based improvement and not by consumer credit going back to high teens or 20% plus growth. So that's the way we see the overall growth. And within that, we think the public sector banks will probably see a slowdown in loan growth, whereas private sector banks will largely hold on to their current loan growth rates.
Okay. What would be the big driving factor now for next 12 to 18 months? And I'm just amplifying it for the benefit of our viewers. Sometimes it is corporate credit. Sometimes it is retail credit. Sometimes it could be the fee-based income, mutual funds, etc., etc. So for next 12 to 18 months, given that retail is down, corporate is down, MFI is down, what will do better, and which are the banks which one should focus on, which in a sense have edge over each other?
Okay. For the first 6 months, I still think it will be asset quality. So while it doesn't get worse, the pain could last for a couple of more quarters. So that will remain focused, especially for the smaller NBFCs. Over a 12 to 18-month view, I think liquidity will be the biggest driver for the various banks, which means that deposit growth and liquidity is what will drive the performance. If liquidity improves, the ones which are starved for liquidity, like say Axis and HDFC, will do a lot better. Whereas if it remains tight, the ones with more buffers will chug along. But for the overall sector to do well, we think liquidity improving will therefore become the key.
I guess, and Pranav, that would make the case perhaps a little bit better for NBFCs and microfinance as well, right? Because now that the RBI has lowered the risk on bank finance for these segments.
Yes, things do get better on the liquidity front from the NBFCs. They would also benefit from the rate cuts, but that largely is priced in. So if you look at the year-to-date performance, most of the NBFCs have already priced in that. The ones which still are down are the MFIs, where the recent actions do help, but you'll continue to see trouble for a couple of quarters. So we don't think it's going to be all rosy from next quarter onwards, and hence our preference for the banks. So yes, I mean operating metrics should improve, but is it already in the price? We think so.
But Pranav, since you say that liquidity could be the key driving factor in the next 6 to 8 months, you will be watching out for that. Help us understand that how are you analyzing the liquidity situation now, and what more steps RBI could actually take to improve the situation in the banking space?
Okay. See, I think RBI is, there are a few steps that RBI can do and has already taken. One is, of course, the open market operations, which they seem to be upsizing at a regular interval. So that is one. The second would, of course, be a further tweaking of CRR. A rate cut would help as well. The factor which works against it, though, is the currency moves. So to us, the biggest boost to liquidity would happen once the currency stabilizes. We don't see further sharp depreciation of rupee. I think that's what will free RBI to act more and create a more surplus liquidity situation. Whereas now, I think the best that RBI has been able to do is prevent it from worsening. So we had the banking sector liquidity almost hit a bottom with 3 trillion rupees plus deficit in December. Since then, things have started to improve, but hasn't moved to the surplus zone. When the rupee stabilizes and RBI doesn't need to step in to protect the rupee, that is where we think the liquidity situation will durably improve. And that would be a big inflection point for the banks and NBFCs.
Simple point that if I look at banks, they account for nearly 30% of the total market cap, broadly, right? That's about a trillion, maybe a 1.2 trillion. Now this 1.2 trillion, A, is an over-owned segment. B, this is one segment where FIs are buying. And with all due respect, I'm yet to find a single person, including buy side and sell side, who said that go underweight on banks. So the positioning for financials is high. The commitment levels is decent. And on top of that, FIs are selling and they own a lot of banks. So aren't we in a bit of a disarray here?
Okay, so there are 2 or 3 things here, right? So one is FI selling wouldn't help banks. So it's over-owned by FIs compared to DIs, and hence when the selling eases, or at least when they come back, which again is linked to some bit of the dollars, rupee moves, etc. That will be a positive for the banks for sure, number one. Number 2, while everyone agrees that banks are relatively attractive, I think there's the fear that you don't want to be buying into a ROA declining cycle, right? So with the rate cuts in, the profitability across the banks will drop with NIM dropping. And you would wait. I think a lot of investors are waiting for that to play out before jumping in. So buy banks because it's cheap is almost a consensus, like you say. But should I buy now, or can I buy 6 months or 9 months later is the big debate. And I think that gets settled once you see signs of the ROA bottoming out. and EPS growth starting to look at mid-teens levels or higher in a very clear fashion. That's what will drive a lot of interest back.
Simplify it. We'll simplify it for our audience. I know you serve and you deal with institutional investors who are sophisticated, but we have an audience who perhaps would like to seek your expertise in terms of breaking it down. If I say that a raw material for banks is money, and the cost of raw material, which is interest rates, that is coming down. That's good news, number one. Second is availability of raw material, which is liquidity, that is increasing. Third, if one looks at valuations, because when you're buying a business, you look at valuations are not looking bad at all. And fifth, if one looks at the quality of banks, which is NPAs, asset quality, even the economy is going through a downturn, NPAs are not happening. So, kul milakar ke kahani achhi hai. That simple message for our viewers.
Yes, perfect. That was a great summary.
Have I missed on anything you can add?
See, I think I would agree with the summary you said, just with one caveat that when rates go down, banks initially see a decline in profitability, but the growth picks up, and in the longer term, banks will still make money at any interest rate level. So short term pain hoga, but then you get back to profitability later on, which is what most investors are waiting for.
Well, like they say, it gets darker before the dawn. I think that's where the banking problems are. It is really the darkest days before the dawn. And I'm sure the dawn will come very soon. We take a break, right?
If you like this video, then like, share and subscribe to ET Now.